Hello, everyone, and welcome to the 12th episode of the Upside Ticker Talk. It is May 5th. We're in beautiful Scottsdale, Arizona for one of our great client events that we run all year long for advisors across Canada. And we thought, why not record another episode of the podcast and make it a special episode where we welcome on a bunch of different guests that are actually presenting here at the conference this next couple of days. Right now, I'm joined by Mark Verrilli, my colleague, ETF strategist based in Ontario. What we're going to do, Mark, I guess, so we're going to do a few other segments with some of the PMs, but today what we're going to do, run through the flows of the last month, as well as talk about some of the key trends. And then you recently wrote a great research note that we sent out to our advisor base, and I want to pick your brain on it a little bit. So that's kind of the schedule for the next 5-7 minutes. So I'll run through it as we usually do, kind of do the rundown, and I'll throw it over to you for any added comments. And I did take some notes, but right off the hop, April is actually the slowest month of the year so far, $13.2 billion in net new assets in the Canadian ETF industry. That brings the year-to-date total to 73. Still way ahead of where we were last year, but still nonetheless, we did see a slowdown in the month of April. Some of the notable headlines that I wrote down: equities continue to lead the way with about $10 billion in net new assets coming in. Really, it's not a cause for concern by any means, but definitely the area of slowdown that I've seen to bring us where we are was on fixed income side, around $900 million in fixed income. Multi-asset continues to do really well. The exact number that I wrote down here, we're talking about $1.3 billion again. It just seems like every month's just consistent, over $1 billion going into that space. And actually 4 of the top ETFs in the month are in that multi-asset category, including, humble brag, FBAL and FEQT here at Fidelity, so we're all in one balance, all in one equity ETF. A couple other things that I jotted down: U.S. stocks. If I go back to equities, kind of underwhelming flows at $2.2 billion, despite a really, really good rally in U.S. equities over the past month, as it seems like, anyways, a lot of the negative sentiment on the ongoing conflict in Iran, oil prices coming down. It seems like inflation worries come down a little bit, and all of a sudden everybody breathes a sigh of relief, and we're back off to the races in U.S. equities, but definitely not on the flows side. And the last point I had, thematic ETFs made a comeback, which is surprising. I feel like we haven't talked about thematic ETFs too much recently, but 2 ESG ETFs really coming back, not here at Fidelity, but in the industry, some demand for ESG themed mandates, as well as Fidelity Global Innovators ETF and Fund, FINN, having a really good month of inflows, as well as performance. It's actually up 20.7% over the last month as of today. And that's good for 23%, or close to 23% on the year. So quite a year for manager Mark Schmell on that mandate. But enough of me running down through the stats. Is there anything that stuck out to you, Mark, that you...
I think that the fact that the U.S. had a slow month of flows relative to both international, which has been a continued trend for almost a year now.
Oh, yeah.
But even to Canadian flows being a lot stronger for equities in the month. It's surprising considering the momentum in hyperscalers in April. And as much as it shouldn't happen, flows tend to follow performance. We've seen strong performance this month, and the flows didn't quite follow suit. So maybe investors and advisors still are buying into that diversification story away from the US. That was a huge topic of conversation throughout most of last year and in Q1 this year. So it'll be interesting to see how that kind of plays out over the next couple of months if we start to see an uptick in US equity flows again. And then, otherwise I think seasonality probably just has a bit of a role in the slowdown that we saw this month. It was surprising to see such big numbers in March. Fantastic for our industry to see it, but surprising. But all that to say, if every month was like April this year, it would still be a record year for ETF sales. So even though it's been a slower month, it's been a slower month relative to tremendous growth.
We've been treated a little bit too well, if you will, over the past 4 months. But no, I really like that point. And you mentioned, I think with regards to Canada, actually, we're going to hear a little bit later from managers Hugo Lavallée and Dan Dupont, who both manage, North American mandates, global mandates, but definitely, obviously, they're in Montreal. They're managing Canadian equities, so it's going to be really interesting to see what they have to say about the Canadian market, because it seems like a lot of the performance has been driven by some of the more kind of cyclical, obviously, areas like energy due to oil prices moving up. Materials has been outstanding due to precious metals over the past year. So I guess investors kind of comfortable with that allocation right now. Anyways, it seems like where I'll go next is, I did mention it in that intro there. International equities continue to be quite hot in terms of flows, in terms of performance as well. Continue to outperform. Actually, I say that I'd have to look as of the end of today. But
I think the U.S. is about a few percentage points ahead now year to
ahead
date.
now. Insane how 1 month can change everything. But it's been obviously like a market that's worked over the past 18 months, but the ways that investors and advisors have been allocating money to that region, if you will, hasn't been, equal, I guess, if you will, across the different types of products. And like some have used active managers, some have used purely passive, some have used factor solutions like we have. So I guess throw you on the spot, like make the case a little bit for, why it seems like anyways, it's working to have a quantitative or factor-based approach on the international side.
If we look under the hood for flows within the regions, in international equities, factor is actually outselling passive. And this has been a trend now for over a year, and it's just getting stronger and stronger each month. Whereas in the US equity universe, it's like 90% passive ETF flows. So completely different. And I think there's some good reasons for that. I think that factor just works better in international markets because of the investment universe and the benchmark that we're comparing ourselves to. Right? Like the biggest benchmark in the US is the S&P 500. Everyone's familiar with that index, but everyone might not be familiar with some of the constraints to become a part of the index.
Sure.
It's not just the 500 biggest stocks in the US. There's an earnings requirement. You have to have positive earnings, GAAP earnings, in the previous quarter and the previous 12 months to be considered for inclusion. And on top of that, there's a committee of people that review M&A activity. This year they'll be reviewing a lot of big IPOs to consider those companies for inclusion. They also look at qualitative characteristics, ESG. They think about your fit in terms of integration into the US market. So there's a bit of a qualitative, subjective lens to that index as well. A great example I always like to give is Tesla was the 6th biggest stock in the US by the time it got into the S&P 500. All that to say, there's more of a quality lens, more of that filter and sift that you talk about in a US passive benchmark versus Canada and international. So let's contrast that with EFI, or the ex-North America Developed Market Index. There's no quality constraints. It's just you're big enough and you're liquid enough, and you're in that one of the 20, 21 countries that exist in that universe, you're in. So what you end up with is a universe of over 2,000 stocks. Much more of those stocks are unprofitable. It could be as high as 20 to 25% at any given time. In the US, it's more like 2% with the S&P 500. So a huge difference. Concentration is much lower amongst some of the largest holdings. So I think it's a lot easier to differentiate yourself, even with a core factor strategy, like our all international equity ETF, for example, than it would be in Canada because it's so concentrated in a few sectors, or the US because the S&P 500 has some of these quality lenses that make it a bit of a stronger index. And that's a really great story, but I think the numbers actually back it up as well. Like we talk about batting average all the time when we're talking about performance with advisors, and batting average just says how consistent are you versus your benchmark. The higher your batting average, the more often you outperform. What we find in international markets is the batting average tends to be higher than in Canada and the US with similar strategies. And it also tends to be higher when we bring 4 factors together rather than using individual sleeves. So I think that kind of tells you, like, 1, diversification works, and 2, these strategies just have more consistency in the EFI universe.
No, I love that. Well, that's awesome. Well, thanks for that, Mark. I guess we'll throw it back over to our next guest that we're going to have on. All right, so we've got portfolio manager Dan Dupont joining us this afternoon. We're in Scottsdale once again. Really nice to have you. Thank you for joining us.
Great to be here. It's my pleasure.
It's obviously the special episode of Ticker Talk, so we're trying to get insights from a bunch of our different PMs that are here in Scottsdale. And Dan, a month from now, it's going to be 25 years at Fidelity. You still love what you do? I mean, it's easy maybe with the Scottsdale weather. But
I absolutely love what I do. I've done so many different things. I was an analyst. I covered precious metals, went all around the world visiting mines. And then I covered banks during the financial crisis. That was also pretty exciting. And now I've done all kinds of products, global, Canada-centric, and a long-short fund as well. So I've had a lot of opportunities to get better and better as an investor. And now, I think I'm just continuing to get better, and hopefully even better for the next decade or two.
I love that. We need you around for at least another 10 years. Dan, like right now, and he was on our ETF shelf, there's 2 mandates that you currently manage: Canadian Large Cap, tickers FCLC, the Global Value Long Short Fund ETF, FGLS. I'll save the new baby coming out soon, but just those 2 mandates, like how do they differentiate each other? And how do you as a PM, and those are just two of the many other pools that you manage or portfolios that you manage. Like, how do you juggle through the different portfolios?
Well, what I do every day is kind of the same. I'm trying to find the cheapest names for the long side of things. So Canadian Large Cap Fund is 100% long. I've been managing it for 15 years. It's downside protection first, and I think we've thrived in doing that. We haven't had a negative calendar year, which is not by design, but it's just so happened when you focus a lot on downside. So that's been a fun one to be, mostly in Canada, 51% in Canada most of the time. I need to be over 50, and then the rest of the world is my oyster for the other 49%. So we'll go anywhere. It really depends where the cheapness is, and we've moved around. We've been to China a few times. We've been to Brazil a few times. A lot of Europe right now.
Okay.
And then global value long short. I do the same thing on the long side, but the short side, I'm very courageous in attacking the most egregiously overpriced stocks in the stock market. And so it creates a fund that is overall fairly volatile, but it is the ultimate fund to own, I think, if you're someone that's very bearish right now, because whatever I'm shorting is incredibly expensive. And as people can look at the performance historically, we've had a few tough years because I think the speculative market has come back. But when we have a bit of a wobble in speculation, like 2022, that's when we can really show what we can do. So that fund was up 68%. And I'm not saying the exact ingredients are back on the table, but I'd say,
it's starting to smell a little bit.
Well, the ingredients are in place, let's say.
Okay.
And so we could cook something that's similar.
Okay. Well, I guess maybe before we get in, because for those that don't know, we're actually launching a brand new fund that's going to be managed by Dan 20th of May. Super excited about that. Remind me the name because it is a little bit of a mouthful. It's
Fidelity Global Concentrated Value.
All right, ticker's going to be FGCV, excuse me. And I'm guessing you don't change as an investor with a new mandate. Yeah, you get a different maybe set of rules or guidelines that you play around with. But like you were mentioning on the long side, it's pretty much the same type of themes or ideas. Like, so maybe starting on the long side, like what's getting you excited right now? And you mentioned a bit of Europe, but like what are some of the main themes in the portfolios right now that you're excited about on the long side?
So globally, there's not that much that excites me. I'd say generally speaking, valuations are pretty high. We've had 18 years of a pretty easy credit cycle. We've had a bit of a wobble during COVID, but that's about it. Nobody really went bankrupt. So as I look bottom up, trying to find things where downside is really protected, there's a few spots. Geographically, there's a bit more in Europe. There's some in Asia. It's all around, staples. It's, spirits and tobacco. And that's really what's more interesting. And now in the last few months, we've seen the appearance of more interesting valuations in software because of the AI phenomenon and people, doing a bit of the work and panicking first and asking questions later. We do a lot of the work and we try to figure out, what's the worst case scenario for these companies? How bad can it get? And then if the market's discounting that or more, we'll buy them.
Okay.
And frankly, there's quite a few that are interesting now. So it's bringing me back a little bit more to the U.S. than I was.
Really?
Pretty excited about that, and we'll keep looking.
Okay, no, that's really interesting. And it's like for those that maybe on the past shows, like you've heard us, we've mentioned probably like different factor ETFs that we have. Like interestingly, this may be something you probably don't keep track of. Obviously, our Canadian Value ETF for the first time in its entire 35-year backtest is overweight tech.
There you go.
So I don't know if that's a sign, but
I'm not surprised.
In February in its rebalancing, it bought Celestica, Constellation, CGI. Once again, it's a rules-based methodology. It's not looking for the best out of say the six, but it's overweight that sector for the first time in a long time. So
it's certainly the most divergent market in a few decades in terms of technologies. There's some huge winners that are priced for perfection, and then there's some companies that are left for dead.
So price for perfection. What don't you like right now on the short side?
Well, I would say some companies are massively discounting some very, very rosy future based on some numbers that are really exciting, but at some point are not sustainable. I mean, the CapEx that is expected this year and next for the really large hyperscalers, like the top 8, is somewhere around $700 billion this year, $900 billion next year, which great, but it does at some point start to cramp up the credit markets, and also the valuation is basically assuming that a lot of that profitability is going to keep going in some circles. Sure, in memory, it's very concentrated. Maybe profitability stays for a little bit longer. But just generally, that's certainly an ecosystem that has created a bunch of overvaluations. So that's why I'm looking, there's quantum computing that is in that periphery. There's that memory that we talked about, some semi-bottlenecks that maybe not as bottlenecked as we think.
Yeah.
And then there's new companies that have been created in the financial realm that are basically thought by investors to be really solid, but they've never been through a full cycle.
Yeah.
So there's a bunch of those areas, but I'd say, when we look back over the last 30 years, to me, it is the best shorting environment potentially ever at this point. It's certainly up there with 2000.
Really? All right. Well, that's a lot of exciting stuff, and I'm sure, obviously, you're going to be talking about a lot of this with advisors tomorrow.
I will.
Is there any other topics that we might have missed in those two that you're thinking of, or that was some of obviously the main ideas?
So the one thing that I'm going to be, sorry to cut you off there.
No.
But I'm the one thing I'm going to talk about tomorrow is so that $1.6 billion trillion number that's coming up in terms of financing for the hyperscaling infrastructure buildup. It's in the middle of all of that financing scope of, it's very easy to borrow money right now. I mean, there's a $100 billion deal right now for cash, right? Warner Brothers being acquired by Paramount for $100 billion cash. And then day one, JP Morgan came out and said, we'll finance a bridge loan for $20 billion. That's how easy the market is right now. You have EA, Electronic Arts being acquired for cash, $50 billion. So credit markets are wide open despite the wobbles we've seen. So I'm going to discuss a few of these things and how maybe, we could see the beginnings of, the air coming out of the room. Because government rates are going up. All those spreads are still pretty tight. Like everything's kind of drifting up a little bit together. And those are the first things that created some problems in 07, 08. I'm not saying that we're seeing big signs, but things to think about.
Yeah. Okay. I love that. Well, we're going to wrap it up there. Dan, it's been awesome. Thank you so much for joining us.
It's
a pleasure.
I mean, this is the place that if you want me to interview,
nice. Exactly. We'll do it again.
Happy to do it.
Thank you so much.
You're welcome.
All right, we're back with another portfolio manager here at Fidelity Investments joining us. We got Hugo Lavallée. Thank you so much for being here. It's great to have you. I'm going to ask him a few questions about his investment style. We're going to talk a bit about Fidelity. We're also going to talk about just his overall thoughts on the market. But first question is kind of a softball question. You've been here for 20 plus years. What makes working at Fidelity different than other asset managers? Maybe I should say unique.
Unique? But I was super excited when I joined Fidelity because one thing I remember clearly when I joined, knowing it was going to be different, and I joined in Boston, right? And it's a little bit the same in Toronto. But Boston, what made Boston very special is we had a lobby and all the companies coming in every day. So what I remember clearly is being at McGill in an HR class, watching a video about John Chambers, the CEO of Cisco at the time.
Yeah. And
then started my career, and a few weeks later, there he is actually, visiting in the office and being able to go to the meeting and, shake his hand and whatever, right? But just the access that we get is very special. So to be able to go get the information, the Fidelity name just opens a ton of doors, almost regardless where you are in the world. So we're in April, I guess. So we're in May. So a few weeks ago, I went to Scandinavia, and just being in Stockholm and Copenhagen and visiting companies and meeting CEO and CFOs of companies with the Fidelity name and try to find good ideas to put in the fund. But why it's still the thing that makes Fidelity special, the access, and especially when we travel, it's great to have them come to our offices. But when you're able to go see a company, I've had some great meetings over the year at Disney and others, going to the headquarters, spending time with management team, walking the gold mines or visiting the assets or visiting the plants or whatever. That's why we got into this job, is try to find great ideas. It's like Fidelity 101, Peter Lynch, kicking the tires, trying to find a great idea and trying to make money for our clients.
I love that. Definitely not access that you get in most shops, and it's definitely as an individual investor. That's the type of research and access that you get, obviously, through working through a portfolio manager like Hugo. And speaking of portfolios, You manage a number with us at Fidelity, obviously, but one, obviously, the name of the show is Ticker Talk, so I'll ask the one that we do offer as an ETF as well, which is the Fidelity Greater Canada Fund and ETF, ticker's FCGC. Minimum of 51% in Canada, but it does give you some flexibility definitely on the rest of the portfolio. Kind of where's your head at right now with regards to positioning that mandate specifically, and is Canada back? Is Canada back a little bit?
I think so, and today I'll talk about it tomorrow with clients, but I'm excited again about Canada, and we haven't really been that excited in over a decade, maybe 15 years. So just for context, I started running the Greater Canada Fund in November 2011.
Okay.
And so that's like almost 15 years ago, and I've been overweight U.S. right in that portfolio forever until last fall, kind of September, October, started to make big changes in the portfolio, kind of back to Canada. We have a new prime minister. The plan is good. Now we have to execute on that plan, but we definitely have a better plan. Look, the world needs what Canada has, just very simplistically, between our resources from metals to energy to ferts to uranium, to talent as well, right? We're more than just commodities, but just generally keeping it simple. All the events that's happened over the last year, the last few months, showing that the world is in it's a difficult spot, and there's these pain points. And countries, we're very blessed in North America, we're blessed in Canada by having energy. And energy comes in very different forms. And a lot of countries don't have that luxury. So for us to be able to benefit from that, from exporting what we have to others, from nat gas to copper for energy transition, electrification, whatever. I mean, you almost name it, we got it. And I think the plan is good. The current plan is good. Now we have to execute it. Can't fight too much between provinces. But I'm excited. And, we're going to follow the money there. So back into, what makes Canada great in construction and exports and things like that. So, if you think about Greater Canada specifically, so I was at my minimum Canadian content for years, and probably well over a decade, or really close to the minimum. And now I've really bumped that back up and kind of really diminished my U.S. holdings. So, Canada outperformed last year, the S&P 500. As of today, we're early May. It's outperforming again. We'll see where it's settled by the end of the year, but I'm excited, and that's where I'm spending a lot of my time again.
Love that. Sounds like definitely a theme that's at least definitely been working since you said you've been repositioning that since the end of last year. It feels like that's a place that's been working. But where I'll move is more, you've described yourself anyways in the past, maybe that changes over time, but you described yourself in the past as a contrarian investor and liking and being comfortable in places that are uncomfortable. Maybe where's an area that you've kind of been ahead of the curve that it seems like everybody wasn't really liking it, but you were there and you've participated, I guess, in that.
Yeah, so let's define that a little bit. So contrarian is being, it's betting against the crowd, or I like to call it being earlier than others, right? It's being early. Contrarian is not like, oh, we're in Arizona, it's blue outside. It's like, no, we're in Alaska and snowing, right? So you got to draw a line somewhere. There's a limit to being contrarian. But it's trying to see things that maybe others don't see or haven't understood yet, or being early when things sounds bad, but you see potential of things changing. So, the best thing I've done the last 6 months from a contrarian basis is buying energy again, Canadian energy again. Probably around last November, and really, I had some names, but really making a bigger part of the fund, where, say in Greater Canada, as of today, we're a little bit less than 15% of the fund. And, I've been basically nowhere in energy since 2016, so like almost a decade. To the point where, I think Canada can be investable again, what we said a little bit earlier. I think long life energy molecules in Canada are cheap. And if we can develop, our routes to markets, which we talked about a little bit earlier, that can have a fundamental re-rate of our energy molecules. So if I bring you back 20 years, that was the thesis on Canada, right? Like the world's in need energy, going to run out of energy. Didn't exactly happen that way.
Cycle,
and then we had the Permian, and the Americans end up producing a lot more oil. But you see what's happening now with the world. I think So, going back into, and there was no, the NASDAQ's really high. There's no need to own hard assets. There's no need to own energy. And the fundamental reason why people didn't like energy is it looked oversupplied into 26. And people say, well, maybe 27's better, but 26, there's just too much supply. The price can be stuck at 55 to 60. What I did is I asked my analysts, let's run some numbers at 70 or 80, not crazy numbers, but just a little higher. And wow, they look quite cheap on our free cash flow yield. So if oil goes up $10, and if it goes up 20, stocks are going to look real cheap. And then, of course, I didn't predict anything that happened in early March, but just to have that free optionality.
Yeah, no, absolutely.
When people are really short. So let me close on that for contrarian investing. People are really focused on the short term. And it's using duration, right? Duration is the concept of time. I have a little bit more time than most. I've been at Fidelity for 24 years. I've been at PM since 2008. I run Greater Canada since 2011. I can focus on a little bit more. We're not talking 10 years, but hey, maybe if something different happens, the world, gold's going up, there's things happening, the world is changing. What if something happens to the world and something did happen? And energy stocks have been pretty good year to date, and they're helping the return of the fund where a lot of other sectors are under pressure because of macro events and economic events and events that are happening in the world.
Awesome. Well, we're going to wrap it up there, Hugo. It's already been great. We're doing these short little segments, but I hope we can get you back on maybe in Montreal. No,
absolutely.
I won't get you to make any promises, but
it won't be as hot.
No, it won't be as hot. But yeah, that was great. Thank you.
You're welcome. Thank you. Merci.
All right, we're back with another guest. We're in Scottsdale, a special episode, and we have Ilan Kolet joining us. He's IPM, our institutional portfolio manager for our global asset allocation team. So, we've heard from a few PMs, but now we're going to go into the macro side. We're not just going to talk about stocks. We're talking about some of the main themes that have been driving markets over the last couple years. And then I got a few other questions that I know people are interested in, such things as gold and inflation, and which are all definitely tied into global macro. But Ilan, you've been at Fidelity for 12 years, a little bit more than 12 years?
That's right. Yeah, I started in 2014 down in Boston on the asset allocation research team, and then 2021 moved up to join great friends and colleagues, David Wolf and David Tulk, up in Toronto.
Awesome. And before that, you were working at Bank of Canada as an economist, so you've got a wealth of knowledge and background with regards to the macro side. And one of the things that we've always been told by yourself and by others, you're kind of the resident inflation expert on inflation research. So let's start there. It's fairly topical, obviously, with everything that's been going on with the conflict in Iran. Yep. Commodity prices had risen, maybe with the exception of gold, which kind of topped out a little while ago, but still, energy prices going up. It seems like inflation expectations, at least, are more topical and rising. What are your thoughts there, and kind of unpack that a little bit?
Yeah. So it's funny, when I was down in Boston as the head of inflation and commodities analysis, I joked that the hardest thing about that job was making a number that hadn't moved in 25 years, interesting every month, right? So, it's going to be 1.9 or 1.8, and then it goes to 8%, right? And so we had this surge of inflation through COVID. In general, both in Canada and the US, inflation was very low and stable. It got out of control and accelerated to 40-year highs. It's rolled over and has come down. In Canada, it's roughly where the Bank of Canada would like it to be, which is why one of the reasons why rates are in this sort of holding pattern. Yeah. In the US, that last mile is actually proving to be difficult, right? So we're in the high twos, I would say, on core measures. And the risks are different in the US versus Canada, right? So the risks in the US are, the downside risk is sort of disorderly trade negotiations resulting in a really negative shock that would push inflation lower and materially affect growth. The upside to inflation in Canada is the pass-through of tariffs. And then really potentially if this oil price shock propagates even higher and feeds into other components of inflation. In the US, slightly different story. What's proving to be sort of stubbornly elevated is our service prices, which are affected by the labor market. But inflation is not really where the Fed would like it, which goes a long way in explaining why they've taken this wait and see approach.
Interesting. And so there's a combination almost of kind of longer term impacts as well as this now supply shock that's causing like short term things. Like, the big risk is if they both become kind of longer term risk. Is that, am I crazy to say that?
No, you're not. No, not at all. I mean, I think one of the things that I always like to stress is inflation measures the rate of change in the price, right? The price today, the price 12 months ago, that change is the inflation rate. Nothing is getting cheaper, right? So like, food, for example, is 30% more expensive than it was 5 years ago. But we are at a point where there are some pretty significant risks, right? So the risks to oil prices, as you mentioned, is no one really knows how long oil prices are going to stay where they're at. Most people assume this is kind of a temporary shock. Once the conflict resolves, things go back to normal, and it doesn't feed into other components of inflation. The problem is there's only so long that businesses can wait to pass on that price increase, right? And eventually, all the stuff that arrives on trucks to the big box stores that we go to eventually has to inflate and get more expensive. That's a much more problematic, widespread inflation that the Bank of Canada and the Federal Reserve would need to do something about.
Interesting, very interesting stuff. And I guess I'll shift over to, that's one of the components that goes into deciding your guys' asset allocation mix and like positioning in the portfolios. And you guys manage a number of different portfolios at Fidelity. What are the assets at now?
So we're just over $100 billion. Yeah, for multi-asset
$100 billion.
Yeah. So
and none bigger than, I think, from anyways, from my perspective, the global balance portfolio, which is kind of like the hallmark, or like the main one that we think of. Available as an ETF now as well, which is awesome. So that means you can get it. If you're an investor, you can also look at these types of solutions and get this type of management, through an ETF. Ticker's FMPB. Where's current positioning at right now? Like, what are some of the ideas that you guys like, and maybe things that you don't like as much?
Yeah, so positioning now, I would say, is materially different than if we were having this conversation, say, at the start of last year, right? So the big, broad themes, which again we highlight in our Q2 thought leadership paper, which I encourage everyone to read, is called Conflict Favors Commodities in Canada. Spoiler alert: we are now leaning into Canada, right? So for the first time ever on my time on the team, the first time really in the history of these funds, really, I mean, it's no joke. We are now leaning into Canada. For a very, very long time, we were leaning away from Canada and leaning into the US. We're now leaning into Canada. We're leaning into the Canadian dollar. We're leaning slightly away from the US. Now, again, that doesn't mean we don't own any US. It means the allocation, the baseline allocation in the fund that is US, we trim slightly. And then we're also leaning into inflation protection in the form of gold and tips. But the really big change, I would say, is the lean into that commodity exposure, which is going to come through, obviously, commodity exposure, but also really through Canada, with 40% of the Canadian market being, energies and commodities.
No, that's awesome. I guess you opened the door there for gold.
Sure.
It's been such a crazy topic, I think, over the last, I'd say, most people, I feel like, had hit their, most investors advisors that we talk with, hit their radar last year.
Yeah.
But gold's been going up since early 2024, mid 2024.
That's right.
And you've had this kind of gradual increase, and then this the last hoorah, it feels like, at the end of last year, beginning of this year. Yep. And now it's kind of come down a little bit, but still, nonetheless, at significantly higher price. I think yesterday is 4,500 approximately, give or take. How do you guys use gold other than the inflation? Is it purely for the inflation part, or is there
it's not just
some type of play on other macro themes?
So it's not just that. I mean, gold is an interesting one. In 2022, I was talking about the importance of owning gold to protect the portfolios against inflation and inflation volatility. I mean, it's a bit nerdy, but inflation and inflation volatility messes up the inverse correlation between stocks and bonds.
Yep.
So you need uncorrelated assets.
Definitely saw that
gold.
in 22.
Exactly.
Example,
So in 2022, from an absolute return perspective, you needed to own gold. So inflation and inflation volatility. The second one is geopolitical risk. No shortage of examples there.
Yeah.
And then the third one, which is, I think, was the real motivation for the strong performance of gold last year, was US dollar debasement and depreciation, right? So in an environment where policy decisions are just much more volatile, that sort of speaks to US dollar depreciation and debasement, and that, I think, fueled a lot of the interest in gold. The thing is, with gold, I mean, everyone wants gold in a year like we had last year, but gold is a tremendously volatile asset, so you need to size it appropriately in our funds, because we think about returns in a risk-adjusted manner, right? So a little bit of gold goes a long way. I have about a 2% allocation to gold right now, which is, we've been trimming a little bit, but recently actually we've been buying back.
Oh, all right. That's all the time we had, and I don't want to take any more of your time. It's so awesome to have you out here, and hopefully we get you back on. I mean, maybe not in this setting exactly, but you know, I'm sure we'll have a chance to talk to Ilan again. So yeah, thanks, man.
Thanks very much. Enjoyed it.
And that's a wrap from Scottsdale. I hope you guys really enjoyed that special edition of the Upside Ticker Talk. As you can see, we're back in Montreal and we're already missing the beautiful sun of Arizona. You can always, once again, catch all of our episodes on YouTube, Spotify, your favorite podcast app. As always, thank you very much for tuning in, and we'll see you next time.